My name is Michael Denuzzo, and I'm speaking on behalf of Nicholas or JC as well. We analyzed two companies. First is BJ's Restaurants. The second was Buffalo Wild Wings. The shareholders of BJ's are Eagle Asset Management, BlackRock Institutional Trust Company, the Vanguard Group, and many more. Between Buffalo Wild Wings and BJ's, they share three major common shareholders, which are BlackRock, the Vanguard Group, and Fidelity Management. BJ's currently has 28 million shares outstanding, while Buffalo Wild Wings has only 19 million shares outstanding. BJ's has a larger float percentage with 20% of inside ownership compared to Buffalo Wild Wings, which only has 10% of insider ownership. BJ's current debt ratio is 33.78%. Buffalo Wild Wings' current debt ratio is 35.81%. Cost of capital for BJ's is 5.9%, which is smaller than Buffalo Wild Wings' cost of capital, which amounts to 6.84%. The optimal cost of capital that we found for BJ's would be 7.8%, while Buffalo Wild Wings would have to be 6.9%. The current value of BJ's we found to be $897, almost $898 million, compared to Buffalo Wild Wings, which is valued at $1.43 billion. Shareholders definitely care about the cost of capital, and especially for smaller publicly traded companies such as Buffalo Wild Wings and BJ's, the cost of obtaining capital is much higher than it is for bigger companies. So far, BJ's and Buffalo Wild Wings have always made enough of a profit to cover their cost of capital. BJ's and Buffalo Wild Wings betas are both very close to 1, which means that they share about the same risk as the market, and they are both AAA rated bonds. BJ's and Buffalo Wild Wings' pre-tax cost of debt amounts to 2.65%, and their after-tax cost of debt amounts to 1.56%. Since their cost of debt is very low, we can conclude that the amount of risk that the restaurants are taking is fairly low as well, since they do not do very much borrowing. They run strictly on equity. These two graphs show BJ's on the left and Buffalo Wild Wings on the right, their 5-year stock returns monthly. These are their 2-year stock returns weekly. Here at the top we have a graph of the restaurant industry's average figures. This is out of about 65 firms. The average beta for 65 restaurant firms is 1.16, which is greater than BJ's and Buffalo Wild Wings beta. The average cost of equity for the restaurant industry is 8.48%. Equity divided by their debt and equity is 88.38%. Standard deviation in stock, 50.92%. Cost of debt, 3.26%. Tax rate, 19.23%. After-tax cost of debt, 2.63%. Cost of capital, 7.8%. As you can see, the restaurant industry averages are much higher than BJ's and Buffalo Wild Wings are. The cost of capital was calculated using which is the weighted average cost of equity, debt, and preferred stock. BJ's weighted average cost of capital came out to be 9.91%, and the WACC for Buffalo Wild Wings came to be 5.87%. Can adjusting the capital structure lower the cost of capital? Adjusting capital structure is easy if the company has less than the optimal amount of debt and would like to increase its debt to equity ratio. In order to adjust the capital structure, you need to borrow the appropriate amount of money for the purpose of using the proceeds to repurchase some of its stock to adjust the capital structure to an optimal level. Here's a graph showing basically the effectiveness of a portfolio restructuring, a financial restructuring, and an organizational restructuring. And as the graph shows, usually financial restructurings are the most profitable, and they have the strongest positive returns. And in large part, it is due to the high returns reported in studies of leveraged buyouts and management buyouts. Debt for equity swaps and other forms of financial restructuring are associated with considerably more modest returns and show negative values in some cases. For the question of would more debt create a necessary risk, it depends. During times of rising tax rates, a higher percentage of debt may be appropriate and thus profitable. Since interest expenses are tax deductible, the tax benefit will increase for both companies with the rise of tax rates. Since BJ's and Buffalo Wild Wings both have a beta close to 1, which is same as the market, it wouldn't hurt them to both take on more debt, thus increasing their overall beta. Creating more debt for the two companies would ultimately increase their firm value because it will add an extra source of income, of course, not income, but basically just of capital that they could use in beginning new projects and expanding their company. Since both of these companies don't typically borrow, they could encounter a decrease in their bond ratings if they decide to do so in the future. Here's another chart of restaurant industry statistics for different figures such as market capitalization, price to free cash flow, and dividend yield compared to the averages of BJ's and Buffalo Wild Wings. A couple things which you could see is that the price to earnings is much higher for the average of BJ's and Buffalo Wild Wings, which is a very good sign for those two companies. And another big difference is the dividend yields, because BJ's and Buffalo Wild Wings currently do not pay out dividends. Unfortunately, the two companies' net profit margins are lower than the average, which is something that they could work on. The three valuation methods we used helped us come out with basically finding which company is undervalued, which one is overvalued, and to see if either one's values were right on the money or not. The first method we used was the net current asset value, which we took each company's current assets and subtracted their current liabilities. And we found that BJ's came out ahead in that, using that method. The second method we used was analyzing each company's price to earnings ratio compared to the industry, in which BJ's came out on top with that as well. The third method, we analyzed book value per share, in which BJ's came out to 12.93 and Buffalo Wild Wings 20.59. As you can see at the top, the trading price as of the 31st of December 2012 for BJ's close to $33 and Buffalo Wild Wings close to $73. So in conclusion, are the stock prices fairly valued? With the high value placed on the price to earnings ratio, we assume that BJ's is the more attractive company. We mainly came up with this conclusion because we have strong beliefs in the PE ratio, and basically that it suggests that as investors with a higher PE ratio, we can expect higher earnings growth in the future compared to what Buffalo Wild Wings currently shows. So based on intrinsic value, price to earnings, book value per share, and net current asset value, Buffalo Wild Wings stock is overvalued at the moment, and BJ stock is undervalued. And that is the end of the presentation, and we hope you enjoyed it.